Have you ever wondered how investors across Asia consistently grow their wealth despite market ups and downs? Imagine having a strategy used by legendary investors like Warren Buffett and Ray Dalio. Buffett once said, "Don't put all your eggs in one basket." Today, you'll discover precisely how Asian investors can diversify globally into US and European markets, protecting their wealth and multiplying returns. Later in this video, I'm going to reveal how global diversity really works, because understanding this is profitable, which can drastically elevate your financial portfolio. But why exactly is relying solely on local markets so risky? Here's the issue most Asian investors face. Over-reliance on local markets exposes your investments to unnecessary risk. Recall the Asian financial crisis of 1997 or recent geopolitical tensions affecting market stability. Concentrating your investments solely in local markets can lead to volatility and potential losses. Diversification isn't just optional, it's essential. Research from Vanguard shows globally diversified portfolios historically experience lower volatility and more stable returns. But how can you overcome this uncertainty and invest with confidence? You work hard for your money. You deserve peace of mind, knowing your investments are secure, diversified, and growth-oriented. Imagine feeling confident even during economic uncertainty, knowing your portfolio is shielded by investments in some of the world's strongest economies. Curious about why so many investors prioritize the US market? Let's examine the US market, home to the New York Stock Exchange, NASDAQ, and global powerhouses like Apple, Tesla, Google, and Amazon. Did you know the S&P 500 averaged around 10% annual returns over the past century? Alibaba's strategic investments in US startups have propelled its global standing, highlighting the market's strength in innovation and stability. The US offers transparency, solid regulatory frameworks, and consistent growth, making it ideal for Asian investors seeking stability and profitability. Share some of your US investment experience in the comments below. But why stop at the US when Europe offers equally compelling opportunities? Europe's markets, Germany's DAX, the UK's FTSE 100, and France's CAC 40 provide unique opportunities. These markets excel in offering stability, value investing prospects, and attractive dividend incomes. Renowned brands like Louis Vuitton, BMW, and Nestlé exemplify resilience and dependable returns. Ray Dalio emphasizes Europe's strategic role in balanced investing, especially with its increasing focus on sustainability and renewable energy. Wondering exactly how you can start investing globally from Asia right now? Ready to take action? Here's how you can practically start investing globally from Asia today. Use international brokerage platforms like Interactive Brokers or Saxo Bank, or your local brokerage apps offering international investing. Invest in ETFs or mutual funds targeting global markets, such as Vanguard Total World Stock ETF, VT. Directly purchase global stocks by opening international brokerage accounts. Take inspiration from Ravi, an investor from Mumbai, started investing in US stocks through a local app, strategically diversifying his investments across tech giants, renewable energy firms, and emerging industries. By thoroughly researching companies, staying updated with global market trends, and consistently reinvesting his dividends, Ravi skillfully built a portfolio that yielded over 15% growth in a single year, transforming his initial curiosity into tangible financial success. But what about the risks involved? Should you be worried? Of course, wise investing means understanding potential risks. Currency fluctuations, geopolitical events, and tax implications can affect your returns. Think of past examples like the Eurozone debt crisis or US-China trade tensions. Always conduct thorough research or consult trusted financial experts experienced in global markets. Knowing these factors will empower you to invest wisely and confidently. Need some proof that global diversification really works? When it comes to successful investing, Asia has some great stories to learn from. Take Japan's SoftBank, for example. Instead of just sticking to local companies, SoftBank made bold moves by investing in innovative US tech companies like Uber and Nvidia. These investments paid off big time, transforming SoftBank into a global financial leader. The key was looking beyond Japan and betting on the future of technology. Then there's Singapore's Temasek Holdings. Instead of putting all their money in local businesses, they chose to invest in strong European brands like Bayer and Unilever. This smart move not only made Temasek more stable, but also helped grow their wealth, proving that thinking globally can really pay off. According to the International Monetary Fund, IMF, investors who spread their money across different countries tend to face about 30% less financial risk during tough economic times. This shows how global diversification can actually protect your investments. Debunking the myth. Is global investing too risky? A lot of people think investing overseas is way too risky compared to staying local. But that's not always true. While it's true that other countries can have economic ups and downs, spreading your investments across different places can actually lower your overall risk. Think of it like this. If you only invest in one country and that economy takes a hit, your whole portfolio suffers. But if you're invested globally, a downturn in one area might not hurt you as much. How a small change made a big difference. Priya, an investor from India, used to think that putting money into foreign stocks was too complicated and risky. But then she saw how her friend Anil's investments kept growing, even when the local market wasn't doing so well. His secret? Investing in a mix of global stocks. So Priya gave it a try, starting with just a small percentage of her portfolio. A few years later, she saw steady growth and felt more secure, knowing her investments weren't tied to just one country. Why global diversification matters. Investing globally isn't just about making money, it's about feeling secure. Legendary investor Peter Lynch once said, "Know what you own, and know why you own it." That's especially true when investing around the world. It's not just about chasing profits, it's about building a balanced, stable portfolio that can handle changes in the global economy. Imagine being part of the next big success story. Your portfolio could be just like SoftBank's or Temasek's, growing steadily because you took a smart, global approach. Don't let fear hold you back. Expand your strategy, invest globally, and give yourself the confidence to build a more secure financial future. Consider Asia's own success stories. Japan's SoftBank transformed its financial fortunes by investing in groundbreaking US tech companies like Uber and Nvidia. Singapore's Temasek Holdings strategically invested in European consumer brands such as Bayer and Unilever, significantly enhancing their stability and wealth. Well, your portfolio could be the next inspiring story. Remember, investing globally isn't just a strategy, it's a powerful decision that unlocks greater financial security and prosperity. Legendary investor Peter Lynch said, "Know what you own, and know why you own it." Take this chance to redefine your investment strategy. Diversify globally, seize control of your financial destiny, and live your life with confidence and abundance. Now that you know diversifying globally is essential for reducing risks and enhancing returns, you need to know the precise strategies to identify the best global investment opportunities quickly. If you don't know this powerful secret, you could miss out on significant returns, or worse, make costly investment mistakes. Discover the exact criteria top investors use to select winning global investments in my next video.